Bloomberg Audio Studios.
Podcasts, radio, news.
Joining us for the rest of the hour is former National Economic Council Director Gary Cohn. Gary, so much to work through here in terms of whether it's tariffs, whether it's the fiscal policy, or whether it's the deficit. I want to start more broadly. This question of how much are from some of the fiscal policies directing investment theories right now in terms of where some of the money is going and what gates are being put up.
Well, look, fiscal policy and monetary policy are directly impacting how money is being spent, what money is available today. And I think that's even a more important topic. You know, we have gone through a pretty vicious cycle over the last 4 years where we went from a cycle of zero interest rates and abundance of capital available for almost all startups in this country and funding at various stages of your progression from startup to early stage to mid stage to late stage to IPO, to a place where we are today, where there's very little investment capital available for young companies and startup companies, and the IPO market just starting to reopen. So that is all a function of fiscal policy, monetary policy, because they're inextricably linked. You know, when people were not getting a return on their capital in the bank, and there was a zero risk assets out there, you know, people bought assets they thought could provide an enhanced return for them. So they were willing to take more risk. They were willing to invest in startup companies. Today, you can go out and buy a 6-month treasury bill and get 5.3, 5.4% on a tax preferential asset. So we have changed the whole mentality of the way people think about holding capital, investing capital, recirculating capital. Also, with the capital markets having been closed for so long, a lot of that capital that was invested 3, 4, 5, 6, 7 years ago, many of those people thought it had a 3, 4, 5, 6 year duration. They would get liquefied by taking those companies public, and then they would recirculate that risk capital back into the financial markets. They have not been liquefied because the capital markets have been closed, so therefore, that risk capital does not get to recirculate back. So a little bit of the natural cadence of capital moving in and out of risk assets has changed both because of fiscal policy and monetary policy.
There's a lot to unpack right there. Are you basically saying that on the monetary policy side, low rates usually benefit the smaller, more leveraged companies? Rates go up. That benefits more some of the larger companies that are able to be sort of term out their debt structures in a more considerable way. Are you saying that fiscal policy also benefits the bigger companies more because they're the ones that are eligible for some of these grants?
I didn't really say what you're saying. I don't think higher rates help anyone.
Okay.
Like if you're a large company and you're still running a large debt portfolio, you're always worried about your weighted average cost of debt, your WACD. So you're thinking about what that is, and the lower it is, the better it is. You know, ultimately at the end of the day, you know, you sell your goods or you sell your services to your customers. Then you've got your expense line, which is usually the biggest line in the expenses is salaries and costs. But then if you get down a little bit down, cost of debt is a big item. So to the extent that cost of debt goes up, the price of your goods or service has to go up. So companies, you know, either their profit margins contract as interest rates go up, or they have to raise the price of their goods. So in a perfect world, no one really wants interest rates to go up. But there is a sort of middle ground where interest rates are at a level low enough where they're not really affecting. And the economy is growing without fiscal stimulus from the federal government. The question is really more when fiscal stimulus from the government comes in, how does that react? And right now we actually have one of the most unique periods of time because we've got on one hand, we've got the Federal Reserve, which is trying to raise rates to slow down economic growth, to get inflation under control. And we've got the federal government on fiscal policy on the other side looking to invest capital to grow the economy. Those two things are countervailing forces. You know, we don't see a lot of times in our economic history when we've got both of those things going on at the same time. Usually we're in unison. Usually the Fed's trying to grow the economy by lowering rates, and the government is trying to spend money to grow the economy. That's normally what you see as you're coming out of a very tough economic period. When you're in a very robust economic period, the Federal Reserve is raising interest rates, trying to slow it down, and the federal government does not need to spend money because you're in a very robust economic time. This time, it's very different than the historical past.
As an investor, who do you bet on winning? The Fed or fiscal policy?
I don't know if there's a winner or a loser. I think you have to be realistic to what's going on and who's trying to do what. The Biden administration has been pretty consistent on their fiscal policy agenda. They have been trying to spend money and put money into the economy since day one. Since the first COVID relief, $1.9 trillion they put in early. And they continuously find ways to put money into the economy, as recently as relief of student loans. So they're continuously looking at ways to fiscally stimulate the economy. The Fed, on the other hand, is responding to the outcome of that money being put in the economy. There's a cause and effect. Many of us think the effect is so much money being put in the economy, the money supply expanding so quickly that you've got too much money chasing too few goods. And therefore you had an inflationary time and inflationary pressures. And so the Fed is responding to the effect of the cause, and they are raising rates trying to slow that down. So if I were going to bet, the Biden administration will continue with fiscal stimulus. In fact, they have a lot of stimulus already approved where they have not given out the money, so that money has not fed through the economy, and the Fed will continue to monitor the financial conditions, and most importantly, they'll continue to monitor the path of inflation based on the data that they get, and they will decide what rate policy looks like based on that.
Gary, I want to ask you about the next fiscal fight, which is the Trump-era tax cuts. They're expiring next year. Do you think they should be extended?
So, look, I think tariffs is one of the most interesting topics that we dealt with when I was in the White House, and I think the Biden administration is dealing with now. It's interesting, despite a lot of rhetoric, the policies are starting to bend toward each other. It's hard to know the difference between the two, let's call them candidates' policies
today. Do you agree with tariffs? Because they're inflationary.
I'll talk about tariffs. So when you look at tariffs and you think about tariffs on things that we manufacture in the United States and we can sustain ourselves, I think it makes sense to tariff a country that is importing things in the United States at a below cost. So we know that China has some real economic advantages. We know that they don't pay fair market labor. We know that they don't have a cost of capital. We know that they don't have environmental restrictions that U.S. companies have. So we know they've got a competitive advantage. So if they're using that competitive advantage to dump products in the United States that we make, and therefore they're displacing U.S. manufacturers and U.S. jobs, yes, we should protect our border. On the flip side, if they are exporting and we are importing goods that we need, that we do not make in the United States, and there's no replacement for us in the United States, and we put a tariff on it, it basically becomes a consumption tax. You and I and all of us are going to buy those products. We're now just paying more for the same product.
Do you think that we're going to see more of these walls go up, whether or not Biden or Trump get in the White House next year? Like, how high are we talking?
I think there's a thought right now that the wall should go higher. I think at some point there is diminishing returns. We've got a lot of historical data on putting tariffs in, whether there were old steel tariffs under other presidents. When I was in the White House, we did a 301 on washing machines. And if you look at the whole theory of what happened with washing machines, it's quite interesting. We put tariffs on washing machines, but the prices of dryers went up equally with washing machines because, the manufacturers think, well, people think washers and dryers cost the same thing, even though one had tariffs on it and one didn't. Very inflationary to buy a washing machine and a dryer. Did it bring manufacturing back to the United States? Yes, it did. We brought the foreign manufacturers, the LGs and the Samsungs that were importing in the United States. Did they open manufacturing in the United States? Yes, they did. So we did create some jobs, but we really increased the price of the washing machine and the dryer. So there's a lot of historical data on what happens when you tariff things.
How much are you seeing in the companies that you oversee and you invest in this ongoing disinflation?
I don't think we're seeing a lot of disinflation at this point. In the enterprise world, in the corporate world, there's not a lot of disinflation. In fact, most companies right now are trying to figure out how to run themselves much more efficiently because there are a lot of price constraints in the system. And there's becoming less and less ability to push price down into the customers. The customers are becoming much more discerning. So I think what you're seeing in big and small companies today is they're trying to figure out how to run themselves more efficiently. The AI trend is clearly something that everyone's looking at. How can that help me in the efficient frontier? How can I be more efficient with my people? How can I be more efficient with my technology? And we're seeing that in big and small companies today.
When you look at potentially like Bank of America coming out and saying they're warning that the stock rally is exposed to stagflation risk, do you see potential stagflation in this economy?
I'll quote the chair. I don't see the stag and I don't see the inflation. We're still growing. We're still growing at 1.5%, 2%, and the inflation is pretty steady. Look, I think it is. I think we agree that it's going to be harder to get inflation down. The last mile is very difficult. There are a bunch of issues in inflation that higher interest rates won't cure. We've got a commodity bull market going on right now. We've got uranium prices and copper prices and anything having to do with the electric power grid going up pretty substantially. You can raise interest rates as high as you want. The demand for electricity between EVs and between GPUs and CPUs, it's not going away. So we've got some fundamental shifts going on that are going to take some time to just work through the system.
Let's rip up the script a little bit. If you were National Economic Council right now, and I know it's the other side, to President Biden, what would you be doing differently with messaging? Because they're not getting the message across about disinflation, and frankly, inflation is one of the number one issues.
Look, I do think they have to figure out a different tactic on messaging. I mean, we see it in the data. We see that the data tells them very clearly that, the top one or two issues that voters will vote on is the economy. And when the voters in America talk about the economy, it's a very simple equation. Does what I bring home at the end of the week or the month or whatever my pay period is, does it buy me more or does it buy me less than I thought it'd buy me when you came into office? So therefore, is my disposable income going up or is my disposable income going down? The Biden administration has to figure out a way to convey that you are better off today than you were 4 years ago. And if they can't figure out a way to convey that, they will lose on this messaging. And the Republican side has done some very interesting marketing on putting out the basket of groceries and showing what the basket of groceries cost 3.5 years ago and what it costs today. The Biden administration has to go out and say, look, this is what you were paying for. This is what you were getting 3.5 years ago. This is what you're getting today. Here's what I have done for you, and here's how I have done it. They've got to actually put a sort of a point on the issue instead of talking theoretically.
Well, they're trying other things. Like this week, they're calling it Infrastructure Week, real Infrastructure Week.
Really?
You see all
I never heard that one before.
Well, why is that not landing? I was with Yellen talking about broadband in rural areas. Why does this land?
Well, I don't know why it doesn't land, but at the end of the day, I heard her talking about bringing broadband. They were in Virginia or West Virginia yesterday, bringing broadband to 700 families. You can take Starlink and bring broadband to 700 families in a minute. You can give them a Starlink password. They brought Starlink to Ukraine literally overnight. And so, these are things that are interesting and they're good and they're important, and everyone should have the internet. No one should argue about that. But these are not major events. And for those 700 people that got internet, it's really important. It doesn't move the needle in the country. You've got to talk in a bigger swath of people when you're trying to move the emotion of the country.
Former National Economic Council Director Gary Cohn, thank you so much.